Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday, the 14th of November, 2019, just getting on to 3:25 p.m. Central Time. So that means these are the settlement prices. They're determined at 3:15 p.m. Central. And as you can see, a mixed bag today. I think everybody's waiting for tomorrow when we get another round of this impeachment inquiry and more witnesses, and we get to see what they're going to say. And will there be anything market moving out of that? The other issue, of course, is we're waiting to see, can China and the U.S. put together anything? We are, as of tomorrow, just a month away from another round of tariffs going in place, December 15th, if the U.S. and China cannot get a deal done on the phase one. I would have thought phase one was easier, but in a nutshell, China wants to go back to what they were buying before this whole mess began. So instead of the $50 billion over 2 years, they want to do about $20 billion, and they want to buy what they need to buy, not a set amount, preset amounts. Then, of course, we still have the issues going on forced transfers, the mechanism to stop that, and I don't think we'll ever get anywhere on them subsidizing the industries they think are important for their government. But those are issues that we know are there, and the question is, where do you go with it? We've been getting something of what I call a dead cat bounce in the metal markets and the gold and silver, but I'm not sure it's more than that. When we look at the S&P, the market, as I said, just continues to squeak out higher highs. The 18-week moving average of closes is way under the market, and it feels a lot different than it did, I think you'd agree, last November at this time. But I always get nervous when markets are making new highs on very light volume, and you're just not getting that push. There's certainly no zest to the current rally. When we move on and we take a look at the current bar chart, you can see you're getting something of what I'll call distribution. Admittedly, the market is still trying to come up here. This is a high close, but I don't expect every single day the market's going to make higher highs. I think that'd be very unrealistic. What we do have is a pattern, though, as you can see, of higher lows, higher highs. Now, if you were to take out 30, 75, 75, you'd break that pattern. I am not saying that would be bearish, but it would certainly break a pattern that went into place starting back here in mid-October, and here we are a month later, and you've continued with the higher high, higher low pattern. In terms of support, the 18-day moving average of closes is right here at 30.56, let's call it and a half. So to get to that number, and you don't have to go there, but if the market's going to come down to challenge that line in the sand, it has to break the current chart pattern of higher lows, higher highs. That'd be a warning sign. Where's the Bollinger Band? It's getting harder to hit because the way that the market keeps moving itself up, that algorithm's still gradually creeping to higher prices. It hasn't begun to arc down. So prices either make the run at it or you go into this stall area, and that seems to be where you're at. But as long as the momentum, the slow stochastic, stays embedded, well, I keep an eye on it. Here's what I don't like. My instinct is, you got so quiet, I get nervous. That's all. Always be nervous. Doesn't hurt you to be nervous. Of course, if you've been nervous over the past 10 years and just stayed long these indices, whew. Still have the embedded reading and the slow stochastic. Now, embedded, it means that both numbers that make up the slow stochastic, they're called a K and a D line, they're the same formula. The difference is on a daily chart, the red, the K line, uses 3 days worth of data. The D line, the blue, uses 5. That's the whole thing. The formulas are identical. So one line whips around the other. As long as both are going sideways over 80, I'm comfortable in saying that the market is locked into a bull trend, and on the break so far we are seeing buyers show up. Where? Well, that'll be the interesting part, because right now, if this market steps back and takes out 82.20, which is 45 points away, but if it takes it out, you could end up with lower highs, lower lows, and then put into play that 18-day average. Somewhere along the way, we're going to get a small break out of this market. I don't know the day, don't know the time, not interested. More interested in playing with the trend. In terms of seasonality, strong seasonals to the upside at this time of the year. In the Dow, embedded stochastic, bullish, higher lows, higher highs. And this market has a little more life to it. It went up for a new all-time high. I don't care if it settled a little lower than that. It's nothing damaging. You still have everything in play. And like the other indices, you just keep your eye that if you're going to keep that pattern alive, you don't want to take out the last break low on the swing line. If you do, you put into play the objective of the 18-day average of closes. And no, that doesn't mean the market's turning bearish. It could be a correction. In the Russell, as I said the other day, we got pretty darn close to that 18-day average, missed it by less than a point. And now what the market is doing is it's working itself out of overbought. A market leaves an overbought situation according to my definition of slow stochastics. When both numbers that were over 80, for example, get back under 70 together. Until that happens, you're still overbought. So I still view the market as overbought. Here's what happened with this market. You went into that lower high, lower low, a downtrend. But because the market's over the 18-day average, the bias is up. My rule, and you have to have rules if you're a technician, is when one is down and the bias is up, they counter each other. I then look to momentum. Momentum had lost its way on the bullishness, price correction, and that's where you're at. So I see more pressure to the downside than upside. When I come to the VIX, look at how you've just locked in on this 18-day average of closes. In the meantime, the market has been able to successfully work itself out of being oversold. Now come with me here to these numbers. See how the numbers, one of them under 24, one of them 17, 22, and then they were embedded prior to that. So it takes time as you work out, but you've now worked out of it. So I have a market that's in an uptrend. The settlement today is 1305. The bias is up and momentum is up. The resistance, if the market wants to run to it, it's the upper Bollinger Band of 1415. If that were to give ground, 1551. Converse. Can anything here turn the market bearish? No. You can stop this miniature uptrend, or the uptrend if you want to call it, if you were to come back and take out the lows right here of this day, which was 1236. The problem is you'd have a higher high, lower low. So the market's in a sideways to bullish configuration. In the bond market, this is what I was looking for. I was looking for the market to make a run back to the 18-day average to reset itself. Now, what do I think? I think a major top has been seen in the market. Take an awful lot for me to think we're going to get interest rates that decline so much to take out this high. And remember, this is an inversion market. So when you get a rally, it means rates are breaking. When you drop, it means that they're going up. And as you can see, you certainly had one of these when you went from 144, and that's where you were in the cash markets there, back to the 19s here. Now you're getting back to a neutral territory. Is the market bullish or bearish? Well, let's assume you settle right here at 158.17. You've got the swing line up, but the bias down since you're under the 18-day average, and you're working off an oversold condition. In the 10-year note, same thing, back to the line in the sand, as I call it, working off an oversold condition. One of the numbers is still under 30, therefore it's still oversold. That could easily change tonight when you reopen. Next level of resistance in both the bond in this market, the 100-day average of closes. In this market, it looks like the settlement's 129.10 or thereabouts. It's going to be either on or right around that 18-day average. So for the moment, this chart actually turned bullish. You'd have to close under 129.09 to not be there. And in TLT, you came up, finished at 137.91. You had a warning sign not to be short, just like all the other interest rates when you took out this high. So you broke that pattern of lower highs, lower lows. Notice, not too bad against that Bollinger Band, and now you're up into the next area, and the next area is loaded with resistance, even though you're in a short-term uptrend now. Momentum up, bias up, swing line up between right where you're at the 18 and the 100-day average of closes. Should the markets decide to reach further, look for the upper Bollinger Bands. Are there reasons to be short them? No. In the dollar index, you went up to the upper Bollinger Band, and now you're faltering and just sort of, whoa, what do I do next? Double bottom today at 97.97. Market finished down on the day. Momentum here is trying to embed. Both numbers over 80 today. Both numbers over 80 yesterday and the day before. So, not the day before. You've had 3 days in a row. If you lose the embedded reading, look for price and the 18-day average to make a run at each other. If the market keeps the embedded reading on these minor pullbacks, look for support and maybe the potential for the upper Bollinger Band. Until it's over, it's not over. But my strongest signal is always the slow stochastic. When we come over to the eurocurrency, you had what we call a key reversal. You made the lowest low of a price break, took out yesterday's low, took out yesterday's high, closed higher. Okay, big deal. You still have the lower highs, lower lows. You have here in the slow stochastic, both numbers under 20, both under 20 yesterday, both under 20 the day before, not the day before. It's the reverse mirror image of the dollar index, and this developed a bearish reading. Therefore, until it's lost, I'm looking for the traders to do what? Sell this market. If you lose the embedded reading, I look for the 18-day average to come into play. Bearish here, bullish still in the dollar. In the British pound, you have a market with higher lows, lower highs. Do you see how these Bollinger Bands have just gone sideways on you? You narrowed in all this area and you're flattened out right now. This is where the market starts churning, and you're seeing that in the price action. It's not my opinion, it's what prices are doing. They're churning as they're waiting for an event to set them free. I don't know what the event is or isn't, but whenever I see a market that's got lower highs, higher lows, and it's just stuck at the 18-day average, I walk away and say, have a good time, boys. In the Japanese yen, you can see how this market finished off today with a nice gain. We had been in a decline. The market was here with lower highs, and suddenly it was developing right with this day, the higher low, as you see, went back to the 18-day average, stalled out there, and now the market's trying to extend. Where's the next resistance? I would guess it's the upper Bollinger Band. Trend up, bias up, momentum up at this point. Support back at the 92.16 level. You wouldn't want to take out this last break low right through here of 91.65 and a half. So we're seeing a rally in the bond futures, a rally in the Japanese yen as well. We're seeing Bitcoin in a downtrend, lower highs, lower low, momentum pointing down. You negate it if you come back through yesterday's high, and that number was 88.80. So that's the number I wouldn't want to see taken out if I was a bear. As long as it's bearish, you're hoping the prices still work their way lower. We seem to be on either side very meekly of the 18-day average of close differential between Brent and WTI crude. As of the close today, Brent looks like it wants to advance on the WTI a little bit. When we come to the Brent here, you've got the pattern of higher lows, higher highs. You've had these in place for a while, but what today did is it took out the previous high. So where I was concerned yesterday with lower highs, higher lows, like we're talking in the pound, it resolved itself today. It's overbought as can be. It's got pretty strong resistance level at 63.47. We'll see what it can do with it. Let's assume the market broke down from here. Let's throw the flip-flop of it, and you took out 61.23. It wouldn't matter. You'd still have a higher high and lower low. So the bulls have the better hand than the bears here, but you are overbought. In WTI, you've got the same thing. You had a resolution today. You came through this high. Now what you don't want to see is the break low right here of yesterday taken out. That number was 56.27, but could you turn the chart bearish? Not if you're looking for a pattern like lower highs, lower lows. If you took that out, you'd have the higher high and lower low. So support still very much in play in both of the Brent and the WTI at the 18-day average of closes. Gasoline's fighting. It's still current tense, fighting a battle at the 18-day average, but the trend is up. You've got divergence here in that momentum is trying to point down. But you go with the idea that as long as the higher highs, higher lows are in place and you're over the 18-day average, that's a better play than being on the short side. And again here, even if you broke through yesterday's low, you'd have the higher high, lower low. So the bulls still have control here. And in the nat gas, I thought when we got to the 18-day average right here that if you exceeded that, and you go listen at the tapes, I don't tell you buy or sell. That's not what I do here. I do that in the morning in my subscriber videos. But that to me was the neutral zone, that line in the sand. And if you take a look, you fought a battle, you made one stab at the 100, and now you're right back fighting a battle at that 18. So it's a market that is, number one, the bias is turned where? You finish 264.40. If that's the settlement, it's still under the 18-day average. Bias is down. The trend is down. You've come into an area of support and momentum is still down. The bears still have the upper hand in this market at this point. If you like what I'm saying here, sometimes reading about it and getting a better guide to these technical indicators helps people. And as such, we've put together with our friends at Modern Trader all these different articles on moving averages, trend lines, oscillators such as the slow stochastic. They're explained to you in a way where I think, number one, you see the physical example of it. Number two, you get to understand them. A lot of people don't understand, for example, price-time relationship, something called the Arun indicator. That's fine, but a lot of technicians look at these things. So if you'd like to get a better understanding, and if you want to slow things down, this is the way to do it. Go to our website, www.iraepstein.com. Right on the front, you're going to see free offerings. Click it. Fill out what you'd want and we'll get it right to you. It all comes via PDF. It's very simple to work with. Or click here. It'll take you right to that if you're watching me on YouTube. I'm Ira. Have a good day.